Hi, good afternoon, everyone. My name is Roshan Kanesan, and welcome to the BFM Personal Finance webinar in collaboration with the Financial Planning Association of Malaysia. Today, with the cut in interest rates, to help stimulate the economy, of course, we've seen fixed deposit incomes fall, and a lot of retirees depend on that income in their retirement. So to discuss ways to manage this and move forward, today we're discussing this with Danny Wong and Edward To of Areca Capital, co-moderating this with me, as always, Malek Ali, founder of BFM Radio and filife. To everyone, welcome to the show. And we'll just kick it off with a look at retirement. Danny, when we take a look at retirement, what are some of the most important things to take to consider before we in our retirement planning?
Hi, good afternoon, everyone. Thanks for having me here. I think the important things for the retirement is actually you have to plan ahead. How much do you need when you retire, and then you have to estimate slightly longer than the usual lifespan. You don't plan for 10 years. In fact, you plan for 30 or 40 years, but up to age of 90. You do the average lifespan of male and female about 78, or 77 kind of things. I think it's longer the better. Then of course the next thing is actually to achieve that whatever amount that you need every month, you have to factor in the rate of growth and also the rate of inflation. These are the few things.
Right, and I think we've got some slides here, so let me just pull them up.
Sure.
All right, so what we have here is basically a breakdown of how much you need to save per month to get a certain amount at retirement. Am I right?
Oh, yes, correct. Right. This table actually shows very useful to us. Assuming that you are now, rather you plan for retirement, you need 5,000 ringgit monthly spending, of monthly income for your life to maintain your lifestyle. So at the age of 55, before you come into the retirement, you need about 920,000 in your bank account so that it can fund you over the next 20 years. Each month you withdraw 5,000.
Right, and this obviously you've got that 3% per annum in retirement. If you're assuming a certain rate there. So if we jump over to the next slide, this is what that looks like in time over the timeline.
Yes, right. In fact, let's say, for example, for someone at the age of 30, if you want to have the 5,000 ringgit per month after retirement or during the retirement, then you need to start to save now. For example, you're going to save 1,428 per month at the rate of 5% during the accumulation stage. So by age of 55, you should have 920,000, and that will enough to fund you for the next 20 years. Each month withdraw 5,000 a month at the rate of 3% per annum without taking much risk on that.
Right. Yeah. Then are these inflation adjusted, or is it current values today?
No, it's at the current value today. So if you want to factor in inflation, then you have to save a little bit more.
And then and then this is kind of what it looks like if you don't hit those returns, right? So that's what we're seeing right now. We're seeing interest rates being cut. So a lot of what fixed deposits used to be, I don't remember this because I never had exposure to this, 5%, but now they're I think around 2.1% at this point.
Yes, and some of us actually has helped our people to, rather, during the course of my business. Of course, we do come across people who want to have their retirement plan. So a few years ago, we say that, okay, if you think that this is good, then 5% okay. But today it's no more 5% FD. So it's only 2, even below 3, even 2 something. So the impact of this lower rate of return, it also means that by the time you reach 55, you may not able to accumulate up to 920,000. Using just now the example, you may have about slightly more than about 600,000. By then, it can only fund you about 18 years rather than 20 years. So end up you may short of money for the remaining 12 years. So that is actually the situation now.
Right, and the last slide that we have here is a very different slide, Danny.
Yes. Okay. That's what we have said. The new environment is encourage our investor to take on slightly more risk. In this case, a little bit, I would say, to the high side of return, that presumably you are at the early stage and you can take some risk because this is your retirement plan. I presume you have other objective and financial objective using other plan. Assuming this is solely for a retirement plan, and you are okay to take the 12% return and the risk during the accumulation stage, then if you really do it for 30 years, I mean, when you're age 30 and you start to accumulate 1,428 per month, but at the rate of the 12% per annum, you will hit nearly 3 million at the age of 55. With the 3 million, if you withdraw 5,000 a month, even the return at 3%, you will leave behind quite a substantial sum at the end of 75. That means you leave a legacy to your children at 3 million then, you see. So you see the difference of the rate during the accumulation state, that if you have the higher risk profile and appetite, you are able to accumulate more when you attain age of 55, and therefore you can have very comfortable situation then. So
right,
that is actually there's an impact of the high return during accumulation state.
Yeah. Right. And of course, Danny, these are all for illustrative purposes. Of course, this is a particular example. There are all sorts of caveats that are here.
Yes.
But essentially, I think what it does is to highlight the differences. So particularly if we look at an example of this, is you save up to retirement and then you consume that savings. And this is if you wanted to continue investing and grow that money later on. But essentially, it's this curve that we're paying attention to when you look at retirement planning.
Yes.
So when it comes to, so right now, this focus today is, of course, fixed deposits. Edward, maybe we can get some of your thoughts here. When we look at retirement planning, what is the role of fixed deposit? Because, all right, in a more conservative stance, I think a lot of people have used fixed deposits throughout their lives. But with these lower rates, I think that function changes. What are your thoughts here?
Yes, fixed deposit is still an essential part of financial planning. You don't want to totally disregard it, but its role and its purpose and its how would you say, its contribution to your basket has significantly changed over the past 20 years. Now, I think we all know history has it that interest rates were much higher 20 years ago. Even EPF was giving us 78% at the time, and at that time we were saying 8%. What, only 8%? So today, fast forward 20 years, the norm is right now 2% in our environment, 2 to 3% if you're lucky. Interest rates in Europe, advanced economies like US, they talk about zero or even negative interest rates. So that's a phenomenon that a lot of people are not even used to or never heard of. It doesn't make any sense if you're trying to save money and yet they're giving you less at the end of the day. But unfortunately, or how circumstance has evolved to what it is today, the fact is that interest rate environment has to be supportive of economic activities. And that's what all governments in the world are trying to do. They're trying to stimulate economies by pressing down the cost of borrowing, the cost of doing business, in hope of trying to get people to borrow money. So in a nutshell, it just looks as if depositors are actually helping out borrowers. Yeah, but that's the scenario we are in right now. But its significance and its role that it's playing in terms of the whole scheme of things, in terms of the basket of your contribution to your savings, has to be changed and has to be looked at it more dynamically and more current.
Right. So essentially, because we're trying to stimulate the economy, we're trying to stimulate borrowing, expenditure, things like that. You want to essentially, in a way, you're punishing saving in a typical bank account or fixed deposit. But so we've talked about how much you need in retirement, how much, what should the role of the fixed deposit be. Let's move a little bit over to talk about what we're seeing happen with fixed deposits right now. So Edward, you've talked a little bit about why the FD rates are going down. I guess the next question is, should we expect them to go up anytime soon? Edward, Danny, either one of you want to tackle this?
Maybe I just say first, and then the boss has last say, right?
Not really.
Well, when it comes to interest rates, I think we are all are of the opinion that interest rates cannot go any higher than where it is, at least for an extended period of time. If you're talking about 1 year, I don't see it going up. Whatever's happened in with regards to the pandemic and all this, I think the impact has been quite broad and quite deep. Certain infrastructure of the economies has been quite severely damaged. So it'll take a while before the old normal returns. Whether there's going to be an old normal or not is another question. But such is the circumstance where interest rates will have to continue to be low for some time. So that is the environment that we're faced with right now.
Yeah, allow me to add on this. I think following the Fed chairman's statement, I think the low rates is here to stay at least for 1 or 2 years. And looking also at the very technical answer to this is actually globally, they are doing this so-called monetary policy or monetary theory where they print money. So when they print money and the money will go into the right segment of the economy and to flood with all the money, hope that you will go to the right area to help the economy activities and to revive the whole spending so that economy it turns to be better. So for that, I think when they print money, the money all going to the right segment, hopefully. But it takes a while to revive the economy. So we think that maybe the 1 or 2 years time, the low rate is here to stay. And when too much money, there's another question actually raised from here. What about too much money by then? So the inflation come in. Yes, the inflation maybe will come in. But what they do is actually they will use a new model like Japan. They will tax the consumer so that they spend lesser, and then the money will just suck up from the market, and then it will be less money because when you tax people, then the money will be lesser. So that is the new theory in Japan and in some of the world, some part of the world, including all the developed countries. But I don't think so Malaysia will have this kind of scenario. So I think FD could even go lower maybe in the next 6 months, could, if the economy depends, subject to the outcome of the economy.
And I think just hearing that, I'm sure there are a lot of people who are concerned, people who have overly relied on fixed deposits because for a long time the rates were good, and if they've done their retirement planning based on this, right?
Yeah.
And I guess let's take the view of someone who is, let's say I'm someone who's heavily invested in fixed deposits at this time. I'm a bit concerned, right? Is it realistic for me to live off my capital? But before we do that, let's just for everyone who's just joined us, I just see the numbers have gone up a little bit here. For everyone who's just joined us today, we're exploring the cut in interest rates and the impact on fixed deposit income, which a lot of people depend on in their retirement. Today's BFM Personal Finance webinar is in collaboration with the Financial Planning Association of Malaysia, otherwise known as FPAM. And today joining me to discuss this, Danny Wong and Edward Toh of Areca Capital, and co-moderating this with me, Malek Ali, founder of BFM and filife. So gents, let's talk about this then. How can I, instead, if I don't want to move my money around, I've got a lump sum there, I don't really have to take care of anyone, can I just live off my capital? What are some of the considerations that I need to pay attention to, considering that I'm risk averse, let's say?
Yeah, for a conservative plan, I think if you think that you want to stay put in whatever you are invested now, or basically the bank deposits or not, it is going harder and harder to maintain the kind of financial objective. Say for a retiree of age of 50 or 70, 60, whatnot, that you previously we maybe assumed that the FD rate at about 3 or 4% or even sometimes higher, then they can live with your income from the deposits. But nowadays, I think the challenge is you might face the problem that you have to lift your capital instead just relying on income, because the rates are coming very low. That when the low rate, let's say 2% or even lower or whatsoever figures, then that return from that, or rather that rates come from your capital may not enough to support your lifestyle. So end up you have to take up from your capital, and that will quickly erode your capital. When your capital gets lesser, then the next income also get lower, because let's say you get 2% previously from 100,000, now because your 2% not enough, you have to withdraw maybe another 10,000 from the FD, you end up with 90,000. Also your 2% of 90,000 even get lower, and then you have to again draw even more from the FD to fund your lifestyle, your day-to-day expenses. That will keep on going that. So end up you may have problem in future.
Right. Just to add a little bit to that, your capital will be eroded for sure, because of the way interest rates are going and where they are today. Just a very simple illustration would be, what if you used to enjoy 3%, and if today is 2%, 1/3 of whatever you were expecting to spend on has been just reduced. It's reduced by 1/3 of it. That would mean that two possibilities: either you will have to readjust your investments so that you can try to push it back up to 3%, or you will have to downgrade in terms of your lifestyle. So if that is something that you can adjust, then of course that's one option. But lifestyle, as we all know it, is something that's not easy for anyone to change. I think what Danny is probably saying is this is on condition that you want to preserve that kind of lifestyle.
Right, and we're here. We're talking but mostly on the investment side, right? Because there are other alternatives if you're facing falling income, whether it's cutting expenses or finding some kind of work or consulting or any of those other things. But right now we're focused on this part. Yes, Malek.
Yeah, I just want to just go into detail a little bit. So if Roshan said he was a conservative investor, what would you recommend? I mean, how would you kind of like say, look, instead of fixed deposits, you ought to do the following things. What are those following things?
All right, allow me to share on this. I think mentally, first of all, I have to accept that it's no more those days that you can rely on the deposits or the bank deposits. So you have to really start to accept a bit on the risk trade-off. So you have to take some not so high risk and go into the, for example, share market. Maybe you can consider about capital protected fund. You can consider about the a real estate fund, or maybe you can also consider somehow a little bit of a bond, but you must study on the bonds, or maybe if you don't know, maybe just to buy some of the higher grade bond funds, and that also can provide you some kind of hedge against the inflation. So these are some options, but at the end of the day, you need to know the trade-off of the risk, including the liquidity risk, including the credit risk, or default risk. So these are things you have to consider.
Can I go into detail a little bit? I mean, one thing is about capital protected fund. Are they truly
Sure.
Are they truly capital protected?
All right, capital protect and capital guarantees are very different. Capital guarantee, that means there's express one party, for example, bank, to guarantee you. So you are taking the credit risk of the grantor, right? So there's a capital guaranteed fund. But we are talking about capital protected is actually by virtue of the structure. So before I go into the detail, capital guarantee fund usually actually there's a fee to pay to the grantor. So at the end of the day, it's not much different from deposit usually, right? So then you have to look at the slightly higher return, but it's actually they call it capital protected or capital preservation fund. And this kind of fund is actually not guaranteed, but it's actually the capital is protected by virtue of the structure. For example, I buy a government back or their high grade AAA bond that unlikely this issuer will go bankrupt. So you have to buy this fund where the fund manager usually, let's say, take 90% or 80% of this money to buy into this bond, and the next 1 or 10 or 20% of extra, they will invest elsewhere to generate higher return so that the overall fund can achieve higher return. So the 80%, let's say in 2 years' time, it becomes 100% because there is actually a coupon attached to the bond. Whenever the bond is saved and 2 years later, the bond is actually able to give you that kind of coupon or return. So your capital eventually from 80% will go to 100%. So initial 20% that the fund manager invests elsewhere may give you extra. Maybe they can bring you another 10%, 20% higher. Then overall, the capital protected fund may be able to give you maybe slightly higher, let's say 5% or 6% to the investor. So that is how the capital protected funds work. But it may not guarantee your capital. You are taking the underlying, which is the bond side. If the bond, say 80% can give you 100% in 2 years' time, then it works well. If it's not, you are still taking the credit of the underlying bond. Of course, the extra is also the fund manager work. How can you generate more return?
Then you mentioned 2 others. You mentioned for a conservative investor,
Yes.
if you're looking at things, you mentioned REITs, and you also mentioned bond
funds.
Right?
Yes.
So which is the less risky amongst these 2? Let's talk about the less risky one first.
Less risky is very subjective.
Yeah.
In fact, you ask as whatever is expert in the fixed income side, but allow me to share a bit here. I think bond fund is also depends on the duration, depends on the kind of underlying bonds that they're taking in. There are certain high yield bond fund, there are general bond fund, there are also high grade bond funds. So come to the bond fund and the REITs, I think relatively, I still prefer a short term high grade bond fund that if they can give you, let's say 4% alternate to the bank deposit, then by all means you can go there. But you can, if you don't think you have that, you cannot find those things. So maybe you have to structure in such a way that your asset allocation play. That means certain portion you still stay in bank deposits, and certain portion you may to go to the general bonds, so then give, let's say 4%. Maybe there's certain percentage, maybe 10% of it, you have to go slightly higher than maybe some of the lower grade bond or long-term bond that can give you maybe above 5%. Then overall, you still can get the return that they used to enjoy. Maybe Everett, you can add on to this.
Yeah. If you just to touch on bond funds is or generally known as income funds in Malaysia. They vary in terms of structure and what constitutes the bond fund itself. So we strongly recommend most of our investors, even if they don't invest with us, to always ask the fund manager what is it that they invest in. Bond funds are not totally absolved of risks. There are risks that is related to the bonds themselves specifically. So as Danny said, we have a choice as fund manager. We have a choice of taking what sort of risks and where we want to park the portfolio at. And of course, we've got a varying degree of tenors, duration, maturities, and the types of investments we do with it. So it's also very important when investors look at bond funds as an alternative to fixed deposits. Ask a lot of questions. Find out as much as you can. Do much more analysis than what you're used to. And if you don't understand, ask questions. And we're always available to help illustrate or to enlighten.
How many bond funds are there in the market? Are there like thousands? At least accessible to Malaysian investors?
Yeah, there are. I would say thousands. I guess in a few hundreds. Again, if you open the papers in The Age or any of these business papers, you'll be able to see different categories, and a lot of them are either mixed assets or they are just pure bond funds. And even in pure bond funds, a lot of them, the information is not readily available if you don't ask. Yeah. And even if they ask, even if they put out information, it's very general information. Yeah. Right? Short bond fund, long bond fund. Even then in itself, it is very, very technical and complicated. So information is quite key.
Okay. So just for knowledge, Edward, you are a specialist in bond funds. You do know your bonds.
Well, I've spent a lot of time doing it. I won't call myself expert. We're still learning.
Yeah. Good to know. Good to know. Danny, you said something.
I think we have been in this industry for almost 20 to 30 years already. So we have seen the up and downs of certain products, even certain products that label as bond fund, there could be some element of risk. For example, there's a foreign bond fund that's subject to foreign exchange risk. There are also high credit bond fund that there's certain portion buy into also equity. So you really have to consult your advisor. What bond funds are pure bond funds? What bond funds are involved in share? What bond funds are involved in high credit risk? And what bond funds are involved in Forex, for example.
Actually, I have a question regarding bond funds. So you're talking about how maybe a part of it can be used for, as you could include other asset classes. Is there a percentage? So does the fund have to be 51% bonds for it to be considered bond fund, or does it be more significant than that? Is there a line or some guidelines there?
There is actually no written guidelines on this, but what I know is actually through labor, if you call yourself a bond fund or fixed income fund, at least 70 to 75% of your underlying asset must be invested in that underlying assets, which is bond in that case.
Just very quickly before we step, can we explain what a bond is to someone who maybe doesn't understand? So equities, stocks, right? The share market, commodities. We typically talk about gold, but bond funds. It's something. Bonds are something we throw around quite often. What is a bond or a bond fund?
In essence, it's a debt that's raised by usually a company that wants to adjust his balance sheet or to have a different structure, borrowing structure in his balance sheet. He can put it in the form of either a direct loan or can come out in the form of a bond. A bond is basically an instrument that is tradable by the market, investors like ourselves, fund managers, or some of them are actually reachable and exchangeable in the markets as well, tradable in the exchange traded products as well. Not all of it, but just a small splatter of it is available there. But this instrument that comes out from these corporates are then invested by investors like us And what it basically says is that the corporate promises to pay at the end of the maturity. And what the characteristic of it includes either a coupon, a regular coupon payments, some of it ranging from as low as 0 to as high as, depending on credit risk. And it usually has a maturity date. And some of the other features that has to be very specific, are very specific to the borrower itself, whether it's comes with a form of security, comes with guarantee, or whether there are pledged assets to it, whether it's secured against land or properties. So there are various kinds of variables that can be input into it.
So in essence, it's a loan, but in the reverse way. So the company is just trying to raise some funds, trying to borrow money. We are the lenders, we're buying the bond instead of, I guess, issuing shares. Yes, Malek.
So yeah, so I guess that's the thing. It's just an IOU. I guess it's instead of borrowing from the bank, they borrow from you through intermediary called the bond. So yeah, so we can become chattias ourselves. Okay, I'm looking at some questions here. But I think I like to get to Penny's question. Penny Ong, she says something about if FD interest rate is low, is it a viable option still to invest in the dividend-paying stocks? I think that's a question. But before we get to dividend-paying stocks, which is quite a thing, just now when I asked about if you're a conservative investor, you've always been investing in fixed deposit. What are the other options available to you? One of the things that was mentioned was bonds. The other one was capital protected funds and capital guaranteed funds. So now let's talk about REITs. Danny mentioned REITs, and then after that I'll go to stocks. Danny,
Yeah.
on REITs, what do you say? Is that you said is that high risk, low risk? It's certainly higher risk than fixed deposit. And I guess like bonds, not every REIT is the same.
Yes, that's right. But first of all, you have to understand a bit of risk. Risk means it's just another collective investment fund that they garner all the money into this fund, and the fund will buy into the properties and then let the income of this property, of course, it's a rental. So the rental will go straight to the fund, and the fund will pay as a dividend to the investor. So there's a risk dividend, right? So because it's the features of the the return from the letting out the properties, so it's called rental. Rental income is actually subject to the economic risk. If the economy is down and then nobody rents your property, then you are subject to a lower income. And the other thing is actually because this one you have to stay for some time to enjoy the dividend payment, because sometimes you will stay too short. Before they declare any dividend, you already exceeded, so you do not enjoy the kind of return. But in fact, you are subject to the market risk because most REITs are listed in the market. So when you buy, you have to pay some brokerages and you will stay for a while. But you come in, then after that, for some reason, because of the market demand supply, the risk price may come up or go up and go down. If you say you need the money and then you sell it at the wrong time, you may have that so-called capital risk on that.
Okay.
So go on to that. So there's a bit of the REITs. I think REITs, there are different category of risks as well. There are also property risks, which most very famous. And among the property risks, you can go into say factory risks. You can categorize it into shopping REITs, shopping mall REITs, and you can go into real estate REITs. You can go into even some other asset class under REITs. For example, you have lately I think there are some plantation REITs on that as well, because you just buy into certain assets that get yield from the plantation, for example, that go into that. So there are different kind of REITs. I think in Malaysia, I think famous ones are office REITs, shopping mall REITs, and these are the famous ones. So looking into it, whether the risks actually come with the underlying industry. If you are okay with the certain shopping mall, so you have to study whether the shopping mall is actually able to continue in, for example, this kind of environment during pandemic. They have enough cash to survive, and they can still operating in the next 6 months or 1 year. Then they may continue in operation. But there are some risks. Maybe you have to consider whether their underlying assets may be affected because of this. For example, if you buy into some office REITs and office, everybody knows that it's oversupply in Malaysia. What happens if the REITs actually buy into the wrong assets, and the wrong asset cannot give you the yield that required, and you cannot let out the offices, then you may subject to potentially lower return, and therefore the REITs price may go down, and then you have to hold the risk for some time in order to recover your capital.
Yeah, I can give an example. I think I look at the Singapore stock market, which is quite a big REITs,
Yes.
market.
Yes.
What you see is that most of the mall and office REITs, find it hard to recover because of the pandemic, when the stock price got hit. But interestingly, the warehousing and logistics, those who buy into warehouses and all that are doing, the prices are recovering simply because of e-commerce, right? E-commerce is flooding this. People need warehousing, companies need warehousing space. So those are doing reasonably well compared to the office and the mall REITs. That's the example.
There are some REITs also into data center, for example. So where people use more e-commerce and all these things, and this REITs actually buy into data center where the operator actually needs to use the data or to do their tech stuff. So the data center REITs actually getting more and more popular nowadays.
Yeah, and you don't move data centers every year, right?
Yes,
correct. It's a reflection of circumstance right now. I mean, in regards to pandemic as well. I mean, it's going to change lifestyle. It's going to change working environments as well. So that's why this may have a lasting impact on some of those REITs too.
Yep, good.
Yeah,
sorry, Roshan. I'm just going through questions now. My apologies. Penny then went on. Now we're going now to sort of more like equity type instruments. Is there anything we need to talk about before we get into equities? Because Penny asked about dividend paying stocks. Is there any other asset classes that we need to look before we go to equities in a slightly less risk category?
Oh, there are some already, but I think for time being, I think this is good enough for the investor for the audience to know there are bonds, there are REITs, and then there are some other which is actually you can look at it still good, because for example certain structured product may be able to give you capital protection but yet can give you certain decent risk, the decent return, of course. So actually we have, as a fund manager, we actually think about it, because there are requirements that these retirees may not able to get their financial objective, to achieve the financial objective. So we also come with certain product that we actually set it in such a way that they can get certain fixed return, and by going straight to a certain segment that to provide this return to them. So there are certain products which is quite at one point quite complicated to understand, in fact.
All right, so let's go on to equities now. So I think, as I said, the Penny said, what about, so stocks are, again, different kinds of stocks. Before, would you go for individual dividend paying stocks, or would you go for a stock fund, unit trust, for example, an equity fund? Which is for someone who's conservative, which one should you go for?
I think that here we come into the individual risk exposure, and there are many choices. If you want to really diversify your portfolio from the conventional or traditional bank deposit, you want to go into, let's say, a dividend paying stocks, you also must consider about diversification within that segment itself. If you already choose that, okay, dividend stock is my, I want to buy into dividend stock, maybe you have to consider the liquidity risk of it and also the concentration risk of this. So if you buy individual dividend stock, provided the stock actually perform and actually don't give you a problem, then you're okay. If it's not, then you're stuck into the dividend paying stock, and the dividend paying stock not performing well. At the end of the day, you are very concentrated in that dividend stock, and you are also may consider, or rather may face the capital risk on that, right? So my advice is actually for investors with a limited capital, and you cannot buy, let's say, 15 dividend stock, I would say dividend fund is actually quite a good option for individual, provided you don't pay high fee for that.
Okay. All right. So you diversify amongst all the dividend stocks, and actually to be honest, dividend people, we've been hearing news about companies holding back dividends, right? Because
yes.
For 1 year, or reducing the dividends for 1 year. So there's so that dividend paying stock might have been dividend paying stock, but not necessarily in the future,
Yes, that's right.
Okay. I think there's an important thing to remember, right? That dividends aren't actually something that's guaranteed. Although we have dividend aristocrats who've been paying for years on end and good dividend yields, there are a few things that you need to remember when we talk about dividend yields. One, it's based on the current stock price, right? So a high dividend yield can be based on the back of a bad stock price at this current juncture. So it can give you that illusion of it being a good yield. But at the same time, dividends aren't guaranteed. So going forward, it may not be the same way. So it's easy to get trapped into dividend investing, I guess, and then get trapped in what is called the value trap. But before we move on, if you've just joined us, my name is Roshan Kanesan, and welcome to the BFM Personal Finance webinar in collaboration with the Financial Planning Association of Malaysia, more commonly known as FPAM. Today we're discussing the reduction in fixed deposit income on the back of cuts in interest rates to stimulate the economy. And to help me with that, we're speaking with Danny Wong and Edward To of Areca Capital, and co-moderating this with me, Malek Ali, founder of BFM and filife. Let's continue on this conversation, specifically looking at the alternatives. We've talked about the more conservative one, the safer ones. We've talked about REIT funds. We've talked about bond funds. We've talked about and we included dividend stocks in there as well. I am missing one of the three that we mentioned earlier. What is that I'm missing? REITs, bonds, and
dividend stocks.
Dividend stocks.
Dividend stocks, right?
Yes, yes.
So those are capital protected funds.
Capital
protected funds. Yeah.
Can I dive in a little bit? I think it is whilst we before we go fully, I want to address some questions from Facebook. This one's from Divans Vasudevan. He said, remember we talked about bonds as being one area. He doesn't, and I think there's difficulty with a lot of investors as well. How do you get access to bonds, right? You know, as an institution, you can get access quite easily, but as a retail investor, can he buy directly into bonds, or must he go through a fund manager or or investment manager like yourselves, or is there some bond funds that he can buy?
Bond funds are readily available by fund managers, by unit trust companies. That's available out there. But there are some individuals who like the opportunity or the avenue of going direct, and some of them actually do ask us whether they can. Of course you can, because these days bonds have been broken down to tradable bite sizes, and a lot of it are being encouraged by authorities as well. So they do make it available out there, either through direct purchases through banks, of course, or some of these private wealth managers. There are also the avenue of going through the exchange, KLSE. There are a few bonds which are listed over there, but that comes with also a few challenges when you buy directly into bonds. For one is the liquidity, because anytime that you want to sell off, it is not as easy as the stock market, because the volume is not as high once it's exchange traded. And the other thing you have to consider, if you buy from a private wealth manager, more often than not, it's hoped that you hold to maturity, but there comes a time that you could have a need that you need to liquidate your investment. And that's when it gets a little bit sticky, because that's when you have to go back to the person that you sold to you, and you try to beg the person to buy it off you. That's the other question. The other issue is the size of it. Now, traditionally, bonds have been traded in much bigger sizes than the stock markets. Last time, it used to be a minimum lot would be 5 million. But these days, of course, you can trade in smaller sizes, in a few hundred thousands. But even then, it's a lot of encouraging by the authorities, by Bank Negara as well as by SC. But it's not easy to take off, because, again, at the end of the day, the end investors whose size are fund managers, or big GLCs that have the capacity to invest in them. So the reach to the retail market, it's easier through bond funds, which is readily available through unit trust companies.
Okay, all right, great. Some other questions. I think now there's some question about how about. Oh, okay. I'll cover the exotics in a while. I'll pack them together in a while. I think that, let me put some exotic. Zaidi, for example, mentioned, I guess not exotic as a commodity, right? Gold, silver, and the exotic is Bitcoin. There's also another one who talks about, there's also Lei Ping Chong, who talks about foreign currency, investing in currency. So I would call that exotic as well, because not exotic, it's just very high risk type environment. But before we go through all those kind of exotics, let's talk about fully and squarely about equities now. Now, Roshan was playing the role of a conservative investor. Let's just assume that I have FD, a reasonable amount, and I'm a bit more open-minded. Right? I'm like, no, my gosh, I can't. 2% is not enough for me to cover for retirement. I'm willing to diversify. I'm willing to sort of have a bit. I would want that Danny's slide, just now. I'm not sure whether, that Danny's slide of 12% per annum, right? That's a Warren Buffett track record, right? 12% per annum. Wow, I like that. Of course, not over 1 year. I think you're talking about a longer term horizon, 20 years, right? I like some of that because I'm going to retire in 20 years' time. Danny, you have my ear. What would you recommend me do with the fixed deposit? I'm prepared to liquidate it just for you.
First of all, I think I always come back to you. Whether do you have a spare cash for rainy days?
Yeah.
That's
I got
always
6 months. Let's say I got 6 months. And
yeah, 6 months good enough. 6 months good enough.
Yeah, and then I can live for 6 months, but the rest I want to leave it in your good hands.
Yeah.
I want you to pay me my 12% per annum. How do you do it?
Yeah, I think okay. First of all, as a financial planner and as a fund manager, I always advise investors to keep cash for rainy days. Any excess, then you must put into different pockets. Your pockets will have different duration, different risk profile. So your retirement, you can have longer time, you can take higher risk, because the longer the investment duration you have, the more risk you can smoothen over the time, because there's a mini cycle. So you have a shorter time, you worry that when you need the money actually at the bottom, then you have to cash out at the loss, you see. But you have a longer time, usually you're based on the economy growth is actually on the way up. So the mini cycle move along the curve. At the end of the day, they are still okay because you have a decent long time, then you can see the return. And actually 12% is quite doable. Of course, I cannot promote my fund here, but I think there are funds for the past 10 years can consistently actually over the past 10 years give you on average about 12 to 13% per year per annum, right? That is about more than actually double of your money, about 200% of money over the 10 years. In fact, it's actually doable. You don't rocket science to do it. It just need a consistency we do. So how to do it is actually quite simple. You must have your diversified portfolio, and you want to study the underlying stock. Nowadays very dynamic, markets very, very dynamic. You need active management. No more those days buy and hold, right? I can quote you maybe, this is public information, not that the share is no good. And you used to hold, let's say, public bank, for example, 20 years ago, you actually very wealthy by now by holding 10,000 share 20 years ago and now. But up to lately, it was about $20, at one point. But you hold that $20 and today is come to tens, then you're actually losing quite some fair bit of money. So you really need to know and monitor the underlying. I'm not saying that private bank is no good. I'm saying that there are actually times that it will fluctuate. And there's a time you must really study whether it's good to hold or not good to hold. So nowadays, no more those days that you can hold 20 years, you can make the money. You must follow the development of the certain companies and what happened will be there, because every time the markets keep on evolving and there's a new risk to it, and certain company may be good and there could be 100 years in history, but they can go bust now. So you really have to really have all those things in your fingertips, and you spend time to understand that. And if you don't have that, I think you must engage a financial planner or engage a fund manager to really study whether you have to diversify certain risks. Maybe you have to hold certain stocks, or maybe it's hold the fund and invest in the fund. Let the fund manager worry about diversification, and then you do okay. 12%, I must say, is doable.
Okay, so there's two questions here. One is from Chong Cheng Hai, which says many invest in foreign share markets, e.g. the US. And then there's also Raymond Lai, who says, is buying tech stocks like the FANGs a good choice? But he says for dividend income, I think I can give a quick answer for that. No, you don't buy FANG stocks for dividend income. They don't pay dividends,
yes.
Except for Apple. They don't, no, I'm not sure even Apple does.
Yeah.
So, but I think what they're talking about is, I guess my point to you is, if you were to say to me, oh, Malek, thank you. Yeah, I'm gonna get 12% per annum. Can you get that 12% completely from local markets, or do you say no? I can get 12%, but you must allow me to invest in markets around the world as well as Malaysia. What would you say to that?
Actually, as I say, that we have a fund that produces more than 12% over the 13 years.
In Malaysia,
in Malaysia, 100% Malaysia can be done. Actually, Malaysia stock market are not really give them. A lot of a misconception about Malaysian market. Here, I want to promote a bit of Malaysia shares and put some Malaysia. In fact, it's unfair to label Malaysia shares are not doing well. In fact, Malaysia shares, if you know and you actively study this, there are a lot of gems actually hidden there. And you're able to spot the gem, you can actually deliver even higher than the regional market. In fact, and not saying that US definitely the best one. In fact, US carry a lot of risk as well. There's also for Malaysian to invest offshore, even you choose the equally good stock, you have extra risk, which is foreign currency risk. Even you're able to pick one Malaysian stock as good as the other one is in US, and they perform the same, but the US stock to Malaysian, that whole ringgit, you have extra one risk, which is the forex. That's what I want to remind you.
But the forex risk has been pretty much one way for the last 5-6 years, right? I mean,
yes,
it's been increasing at our expense for the last. So those who invest in US stocks actually had a bump up in terms of ringgit because
yeah, it's volatile in fact.
Yeah,
and come to currency, I think currency is I must say very few can make money out of currencies, and currency to me, I also scared of currency because very risky. It's something that beyond your control. You cannot study of currency, how it moves. You cannot predict how it moves in a very accurate way all the time. Yeah. In fact, currency is something that is beyond, I must say, beyond almost all. That you cannot study a country and how it moves because it's subjective to the country, not only themselves, but it's also the other countries that how they see this country. So very hard to gauge the performance of currencies.
Yeah, so Lei Ping Chong on Facebook, that's your answer. You can't predict currency. Danny would not recommend it for you to play currencies, even a period of 1 or 2 years. I don't think he will be for that. There was another person called Zaidi who's very pro, like, no, not currency, go for gold, silver, and I think this is kind of like what we call commodity
yes.
funds. What do you think about those things compared to equity?
But allow me to share on this before you come to the commodity. I think rule of thumb is actually you must have a diversified portfolio. Again, the financial planning come into a play that so long as you know your portfolio for this objective is to achieve certain percentage. So let's say, for example, I want a 12% per annum. You can have majority of it in the risky assets and with some liquidity of that for some unforeseen circumstances. But the high risk assets you can classify into different segments like growth stocks, even regional stock. You can have a ETF in commodities. You can have currency into it also. So long you know the percentage of this so-called alternative assets may not be form the majority of the portfolio, it is absolutely fine. Even you have some amount of the other risky, very risky asset. For example, you like certain so-called virtual coin, by all means, but not a big percentage to the portfolio. Diversification is a key word. So consult your financial planner if you want to have something. Again, today is not how much you want to achieve, is that how much risk you can stomach in this environment. Risk comes first before return, not return first. You cannot maximize return. You must optimize your return over your risk that you can tolerate.
Okay, all right. There is other areas that people are asking as well. For example, there are so many. This one from Mel Chung. There are so many asset classes to invest in. Wouldn't over diversification be I guess stifling or killing? What constitutes a good diversification portfolio to achieve 12? Wow, this guy's very aggressive, Mel. 20% return. Okay, wow, you can do 20% return, Mel. If you haven't know any fund manager that can do 20% return and double my money every 3.5 years,
yeah,
certain years are possible.
I'll be with you there, man. But is there such thing as over diversification?
But
I guess general theories, financial theories, and all this diversification has always been the rule of thumb that everybody drives towards. But yes, there are. Of course, I think it's more of what constitutes your diversification, and I suppose it's very subjective. It's very pertinent and specific to the risk profile of the investor. And I guess the bigger the basket basically allows you different varying cycles to benefit as well as not maximize. I won't discount the possibility of over-investing in one specific area. If you do over-invest or overweight in one particular investment asset class, that of course can contribute significantly to your returns. But I think we're not about having one good year and two bad years sort of thing. A diversified portfolio basically allows you or ensures longevity. I think that's probably more important from our aspect.
Yeah, allow me to add, Malek. I think people used to hear this word diversification. In fact, I want to clarify this. Diversification actually is not to have many. That means you have 100 stocks, you will call yourself diversification, or 100 asset classes. No, diversification in sense actually you are referring to two things: the risk as well as the liquidity. No point you hold 100 asset class or 100 stock, but none of that you can sell. It's not a diversification. You must make sure that, first of all, it must have a liquidity. The second thing is diversification is actually, if one stock goes up and the other stock go down, then net you're still on the upside, then you're okay because your risk is there. It's a diversification of risk, you know. So when you hold certain asset class, only one asset class, then you're too concentrated. If that asset class go down, then your whole wealth go down. So the diversification concept is actually you must go into another asset class, which the characteristic is actually to the opposite of this asset class. When this one moves down, this one can really move on the opposite side to even mitigate the whole thing going down. So the rule of thumb is actually you will have 2 or 3 asset classes is good enough, unless your wealth is talking about 1 billion or few hundred million, then you may consider other asset class. But in general, if you have even 10 million or 5 million, I think 2 or 3 asset class is sufficient for you to diversify. And within the asset class, you must have, of course, different stocks or different, let's say you have this asset class on bonds, then you must have different bond characteristic. And within the stocks, you also have different stock characteristic, whether you buy a growth stock, a value stock, or dividend stock. That is actually, again, a diversification within the asset class itself.
Yeah. So essentially, sorry there.
Yes.
So essentially, Danny, it comes down to diversification is trying to get different assets. It's not about the number, but it's about the behavior of the assets. Correct? You wanna, if you buy stocks which move one way in one economic climate, you want to have another asset class that doesn't necessarily behave in the same way. So you don't have all your entire portfolio going down if the Fed increases rates or something like that.
Bingo.
Yeah, I think it's so very important to actually verbalize and have a conversation with somebody who actually can help understand. Because sometimes when we as human beings, we have to speak about it. When you speak about it, the more you speak about it, the more you understand yourself actually when it comes to your own personal risk appetite. So when you go through the process of actually understanding so with a financial planner, preferably, then you can actually understand what you're actually looking for, what's your priorities. And with that conversation, it helps build your diversified portfolio.
Yeah.
Now, talk about equities now. Now we'll dive into the core as well. I think we've got the next, there's some questions on equities here. What sectors are you, if you were where you're sitting right now, what sectors will you be focusing on in the equity market? For example, I have a question here from Kelvin LBL on Facebook. What's the view on oil and gas equity? That ties in with a tipster here. Sorry, my boss tells me that this petroleum company is going to go up. So shall I buy or not? Right. So, so I guess that's a sectoral question. I think so I guess what's your view on the equity the sectors that will do well in equities for you in the over the next 2 or 3 years?
Yeah, these are very popular questions. when I go everywhere, yeah, it's actually, especially this time, which sector should I go in? In fact, to me, yes, in general, on a macro point of view, you must choose the positive sector. That means you don't go into a negative impacted sector like tourism, hospitality. But having said that, it is not the rule of thumb that you avoid totally in the tourism sectors and hospitality and just go for, let's say, the healthcare stock and and the tech stock, for instance, that is actually positively affected by this pandemic. But in the actual fact, all come to one point: valuation. It's not the sector that give you the money, you know. It's actually the stock that give you whether it's too cheap to enter or too expensive to enter, right? Give you an example of certain gaming stock, right? So you know which stock that I mean, right? This stock is actually having some money that can last you for 3 years. It won't go bankrupt. And the stock price will go down to, let's say, a price to book of half of it. That means you are buying a stock that you need to come up with $100, but today you only come with $50. You can build that. You can buy the stock. So would you want to buy that kind of stock? And you know that this stock will not go bankrupt in the next 3 years. So there's valuation emerge. The value emerged because of the pandemic. People thought that having this in mind, that this stock will not do well in the next 1 year or 6 months or so. So therefore I sell. But because of herd mentality, everybody go and sell it. The price has go down to very, very attractive. So when value emerge, then it is actually time for you to hold this, because you have the duration of 3 years, for example, and you that this stock will not go down. Then you may want to buy this gaming stock that can hold and diversify a bit to other stock as well. So come back to another one. Then I like, for example, tech stock or the famous glove stock, right? So, but the glove stock, let's say at one point going to very crazy 80 times of PE. Would you buy 80 times of PE at this moment? That means every dollar you put in, you need to wait 80 years to recover your capital. Would you have the 80 years to hold, provided this stay, the PE 80 years stay? So would you have that or not? So would you think that, would you buy a stock that will give you back your capital in 80 years by way of earnings, by way of dividend? So that one you have to consider. You know? So it's not so much of sector, but it's much of the valuation that you want to go in. So oil and gas is a sector. To me, oil and gas is actually one of the best down sector, but you still have to find the gems within this sector itself. Not all oil and gas is good. Not all oil and gas are bad.
All right, Edward, do you have anything to add to that?
Oh, no, I think Daddy probably but I must say, as I said earlier on, that we're deviating a little bit from the topic of fixed deposit.
Yeah, so I do want to bring it back to that as we end. We've got about 3 minutes before we hit 1:30. So let's answer the question. I'm 60 years old. I'm not actually 60 years old, but let's say I am. I'm 60, 65. I've been relying on fixed deposits my entire life, or at least the last few years in my retirement. What are my clear-cut options in front of me? So I could look at a different asset class. I could move the money around, or I could live off the capital. These are the two very obvious things in front of me. What kind of advice would you give someone in this position? Edward, can we start with you?
Yeah, first and foremost, you will have to adjust your mindset that the reality is such that interest rates are low and it will continue to be low for some time. That would definitely impact on your income. So if you are totally relying on that, first and foremost, your mindset will have to be changed to be adaptable to the environment. And then you have to recognize that you will have to look at other asset classes to complement or supplement your portfolio returns. Yeah? So I think we went through a few clusters of assets that we did talk about. Bond funds is one, income funds is one, REITs, dividend stocks. These are all other alternatives that you could throw into your basket to help build back up the required cash flow moving forward. Otherwise, as you said, rightly put it, it will definitely eat into your capital. And if you continue that for a short while, you can probably tolerate until interest rates come back up to a more tolerable levels. But how long will this last? That would be the other question you have to ask yourself.
Yeah, the other way, of course, cut your expenses. And live with it. I think you got no choice. In order to have the very good cup of coffee in the very famous outlet, then you may have the in Mama store already. So no choice if you cannot increase or cannot stomach the kind of risk. Yeah.
All right, Danny, do you have anything else to add to that before we wrap up?
Yeah, I think what do we learn from this? I think we have to be mentally prepared. No more those a day you can get a very high yield. Even EPF cannot guarantee you they will stay 6-7%. You have to really accept that it's actually here to stay. And the other thing is beware of scam. So because of this low yield environment, a lot of people can give you this kind of return. I'm guarantee you, blah, blah, blah. Be careful. Don't fall into the scam of those sweet talk and say, I can guarantee you 5% over the next 1 year or so, you put it in me, I think guarantee come with a cost lah. So you have to really check whether this person is licensed to do this or the backing of this. And
All right. So Malek, do you have anything to add before we to close off? All right, I don't think Malek is here with us anymore, or his internet has failed him. All right, I don't have anything to say except for the fact that these are the options. The low interest rate environment is a real thing. It's going to be like that for some time, as we've discussed. There are a bunch of assets out there, but you really have to think about your risk tolerance when you decide you want to move anything around. Watch this video again, research the things you want to take a look at. But more importantly, it can help to speak to someone about it in a professional capacity, someone who has in-depth knowledge of the situation. But you have some options in front of you. The other option is to hope the capital lasts until you expire, which is a morbid thought, but these are the things in front of you right now. On that note, thank you everyone for joining me today. Malek, Edward, Danny, thank you for your time this afternoon. To everyone here, thank you for your time joining us on Facebook. Danny, Edward, thank you so much.
Thank you very much.
Thank you for having us.
Malek,
Thank you.
All right, to everyone out there, we will see you, I'll probably see you next week, next Tuesday at 12:30 p.m. Thank you, everyone.
Thank you. See you.